Hey everyone, welcome back. In today's episode of Portfolio Analysis, we're going to review the Standard & Poor's 2020 SPIVA Scorecard. This will let us know how actively managed funds performed compared to passively managed funds in 2020. Then later in the video, we'll discuss U.S. Treasury bonds, and I'll try to make the case that every balanced portfolio should have at least some U.S. Treasuries. Given the fact that everything did well last year, you might think that this would be a year where active managers should outperform, but that's not what happened. Roughly 60% of fund managers lost to the total market index in 2020.
Many of our clients, they're in their 60s and 70s, and we have it set up so there's always a good slug of their money in treasury bonds. And I always, from the beginning, I always told them, look, the market could literally be terrible for 7 or 8 years. And you could always, if you ever needed a big slug of money and didn't want to, sell at ridiculously low prices, it doesn't matter. I constantly tell people that even before the pandemic. So I think that was helpful during the pandemic because many clients, said that.
And treasuries did what they were supposed to.
Exactly. And a lot of my clients, they're not as sophisticated, but they'll say, yeah, I know you would always tell us you have half your money in bonds and
Please remember, if you enjoyed this video or any of my research on YouTube or the website, please let me know by subscribing, liking the video, and writing a comment. If you're new here, we have 3 ongoing series on the channel. The first is Portfolio Analysis, where we dig into long-term, mostly passive portfolios. The next is Retirement Planning, where we cover various financial independence and early retirement topics. And finally, we have Stock Secrets, where we dig into active management and trading strategies. This week's video was actually supposed to be an episode of Portfolio Analysis, but then the annual Standard & Poor's SPIVA Scorecard was released, and this event's a very big deal in money management circles, so I decided to do a slight detour. Just to be sure that we're all on the same page here, active investing is different from passive investing in that active investing relies on a fund manager, a person, or a group of people picking stocks on behalf of their investors. For example, ARK Invest's Innovation ETF, ticker symbol ARKK, is an actively managed investment being led by Cathie Wood. There was a time not that long ago when fund managers were superstars. Peter Lynch is still a legend today for the performance of his Fidelity Magellan Fund. Other notable managers include John Neff from the Wellington Fund, Sir John Templeton from the Templeton Fund, and even Benjamin Graham, who's the inventor of fundamental analysis. He was also a notable fund manager in his day. On the flip side of active investing, there's passive investing, which was championed by Jack Bogle, who is the founder of the Vanguard Group. And his philosophy was, rather than trying to hire a manager to pick winning stocks, you should just buy a small amount of every stock in the index through a fund. Ever since Bogle launched the first index mutual fund, there's been a war between advocates of the active management and passive management schools of thought. Luckily, Standard & Poor measures the performance of funds, so we have a scorecard by which we can use to make informed investment decisions in our own portfolios. Remember that it's really difficult to beat passive investing over time. In my Simple Path to Wealth video, I tried to explain why this is so hard in this way. I want you to imagine a 1-year timeline. In this single year, some stock pickers do really well, and some stock pickers do really poorly. Stock picking is a zero-sum game. For there to be a winner, there must also be a loser. When you average the returns of the winners and the losers, you get the market average, or the return that an index investor would earn. This is why index investing is called a free lunch. And this is why index investing is so hated by Wall Street investment firms. In any given year, you earn more money than 50% of all the stock pickers for doing absolutely nothing. Now let's add another year to our timeline. In the next year, some stock pickers have had a hot hand and they earn real good returns again for a second year in a row. But many of the stock pickers that did well last year didn't do so well this year. If we fast forward our timeline out 10 years or so, we see that of all the stock pickers that were doing really great in the first year, just a tiny handful of them are still winning 10 years later. If we assume we started with 100 investors, just 7 of them have managed to beat the market average over a 10-year time frame. And if we go out 30 years, that number is just 2 out of 100. This year's scorecard is particularly interesting, which you'd expect given last year's market. The S&P 500 suffered a max drawdown of 34% from peak to trough, but ended up producing an 18% return on the year. Every single benchmark produced a positive return except the U.S. real estate REIT index, which lost about 8% on the year. Given the fact that everything did well last year, you might think that this would be a year where active managers should outperform, but that's not what happened. Roughly 60% of fund managers lost to the total market index in 2020. Here in Exhibit 1, we can see the percentage of mutual funds that lost to the index in 2020. Large cap funds lost to the benchmark for their 11th year in a row. As for the factors, in 2020, the growth factor returned 34%, while the value factor returned just 1.4%. 62% of growth funds, 83% of mid-cap funds, and 86% of small-cap funds beat their benchmarks. This was a historically great year for actively managed factor funds, but long-term, the same losing trend continues. Refer to the full report for all the factor measurements. As for the international factor, it was kind of a coin toss here. About half of the active funds beat the passive international indexes. And overall, the international trend long-term is fairly poor, with 90% of active funds losing to their benchmark when you measure the previous 20 years of performance. Bonds are much the same as international stocks. 90% of actively managed bond funds lost to their respective benchmarks in 2020. So what's the big takeaway from this year's SPIVA scorecard? Well, I think it just affirms what we already know at this point. It's extremely difficult to beat the index over time, and no amount of single-year performance is really going to change that long-term trajectory at this point. As for the factor fund managers, they should be commended for their excellent returns in 2020. The growth in small-cap sectors did very well compared to their benchmarks. As for value, well, as of March of 2021, value is actually having its best year in a decade, and I really do hope that it comes back, but I'm not really counting on that. My personal opinion regarding value is that software is eating the world, and in 20 years, we're going to be looking back at most of these legacy businesses as failures, not as value stocks. See, when you look over today's set of value stocks, they're mostly just businesses who are unable to pivot to the new digital marketplace. And that's not going to get any easier in the coming years. Last week, during our 2020 portfolio review update, I said this. And those long-term treasuries that we were so impressed by, well, they're getting handily stomped by the S&P 500 now. Can treasuries make a comeback? Well, we'll have to see. Let me add some context here. The reason the couch potato portfolio winning last year's challenge was so remarkable and surprising is because U.S. treasuries and U.S. stocks are supposed to be negatively correlated. These asset classes are not supposed to move together. In fact, when you see this happen, and in this case they both returned around 15%, this should frighten you. The whole reason we lean so heavily on the efficient frontier and modern portfolio theory is so that we have a certain expectation of safety. If these asset classes can both return 15% in any given year, then we have to assume that they might also lose 15% in any given year, which would be a devastating outcome for older or retired investors. Take a look at this asset class correlation matrix. It's important to understand that these values change over time. This matrix that we're looking at here is from January of 2008 through February of 2021. If we look into the makeup of the best portfolios in the world, we find that they are mostly constructed around these correlations. For example, notice how gold and small caps are negatively correlated. This is a cornerstone of our golden butterfly portfolio. The all-weather takes advantage of the negative correlation between treasuries and commodities, as well as treasuries and stocks. Warren Buffett's family trust leverages the negative correlation between short-term treasuries and U.S. stocks. Remember late last year when we created the core coin portfolio? We used this same data to determine which asset classes and in what proportions we needed to create a portfolio that could capture Bitcoin's amazing upside while limiting its downside. This idea of asset class correlation is critical to understand. The reason U.S. Treasuries are so valuable to a portfolio is because whenever U.S. stocks crash, the U.S. Federal Reserve intervenes by lowering interest rates or taking other actions to motivate investors to buy treasuries. It's not that treasuries are inherently beneficial to declining stocks or anything like that. It's that investors expect this reaction and it creates a massive feedback loop. So all of this is just to say, don't dump treasuries because they're dropping in value. Treasuries are just returning to their natural state, and you should keep buying them in whatever percentage your portfolio mandates so that whenever the next recession occurs, you'll have access to this money without having to sell stocks at a massive loss.